How about this? When the stock market declines, for how many years does it continue declining? Because don't forget, we're at the end of this year. So we now know that this is going to have been a down year. Well, guess what? Here's some great statistics. The number of times the FTSE 100, the UK market, declines for 1 year, it's about a number of occurrences in that period I just showed you is about nine times. Okay, the number of times it declines 2 years in a row, in other words, 2018 and 2019, hardly ever happens. Well, four times that's happened, and then 3 consecutive years, about 3 times that's ever happened. That's the UK. And those UK probably, well, could, 50% of the time it declines 1 year, it declines 2 years. But here's something interesting, my friends. The US market, the number of times it declines 2 consecutive years, hardly ever. Hardly ever. Okay, hardly ever. That's what I want you to take from that one. Gets better. UK average return 7.9%, US 7.4%. That surprised me. I thought the US would grow more than the UK. Yeah, but this is what's more important. This is what is going to blow your brains out, people. Year after a fall, right? So this year's a fall. So 2019, 8.9% from the UK. Year after a fall, US 9.2%, roughly the same, okay? Right, so this is what we're looking at. As things stand, if it goes by average, and things never go by their average, all right, you're looking at an 8.9 to 9.2% rise. Then you might think, well, that's not enough, it still might not rise. How about this? How about this? This is the US stock market annual returns. In red, each one of the blocks are in red, what happened after a declining year, and in blue after a rising year. So really it's the reds which interest us because we've just had a declining year in the US markets, okay? Some years you've got almost 50% returns, you can see that, all right? Of course, you've also got some years where you've got a massive decline. Okay, well, translate that into actual numbers up. Some years it goes up, some years it goes down. Yeah, fine. Same with the UK market, okay? Just because you've had a declining year, you can next year have almost 50% rises and so on. There's some of those. There's also some sharp falls. So what does it actually mean? This is what it means. The stats suggest there's a 30% chance of a stock market rally of more than 20% and a 12.5% chance that it will slump another 20% next year. That's it. That's all I can put it in. That's actually what I can put it in. What that tells me is this. I'd be happy to buy and hold. I'd be comfortable. And I have buy and hold stocks, and I'll talk about those later. But you know what I'd rather be doing? I'd rather be each day scanning each of these, not just stocks, but you've got currencies, you've got indices like the FTSE, the Dow, New Zealand dollar, Swiss franc, Citibank, Bitcoin, cryptos, Amazon, DAX, gold, Marks and Spencers, all the rest of it. I'd rather be trading off the back of the markets and trying to make even more than trying to make a paltry 9%. 9% ain't going to do it after 12 months. Okay, it's like, all right, what I'd rather be doing is trying to make a lot more. I think next year, if it's as volatile as we expect it to be, and there's no reason why the volatility would diminish given Brexit is going to happen next year, given that it's Trump, okay, and election fighting starts next year, okay, they're going to start full-fledged, and the government's shut down. Come on, you're going to get what you've seen in December, which you're going to get sharp fall, sharp rises, sharp fall, sharp rise. It's going to be a trader's market. That's my point. It's going to be a bloody trader's market.